Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Diversification is the only free lunch in investing, yet many investors choose to overweight the domestic stock market. Off-the-shelf portfolios often include shockingly large allocations to British firms.
I want to know whether home country bias is a problem or if there are good reasons to favour domestic stocks. And in today's dumb question of the week, what are safe haven currencies? All right, let's get into it. For much of the last 100 years, you only really could invest in your domestic market. That was just the way the world was. There was capital controls, and you either bought your own country stocks or no stocks. But for 40 odd years now, the world has been gradually opening up and welcoming foreign investors. Yet the evidence shows most people still carry a large domestic overweight. There's a home country bias. So let's start with, what do we mean by home country bias?
Well, let's say we compare it to a global market cap weighted benchmark like MSCI ACWI, the All Country World Index. If you do that, then the UK only makes up 4% of the global allocation. So it's a very small part of the global equity market. If you look at fixed income, it's a similar story. Which country dominates? Well, no surprises, it's the US. And that's been the case for a very long time. The US has made up about half of global equity markets for around 100 years, on and off. And yet, people in the UK tend to have a high UK allocation, either because they're very familiar with it or because that's just what their pension provider put them into.
Yeah, so I've seen some stats that, like you say, UK is 4% of global markets, but UK investors have around 26% of their portfolios in UK stocks. And that's data from Vanguard.
So funnily enough, I've always made fun of Vanguard's life strategy funds and refused to buy Life Strategy 100 as a global equity fund because of the UK overweight. And it always makes me think, what do they know? What is it that's made Vanguard have this overweight and stick with it? And so there must be a very good reason to do that. And I think some of the evidence we'll discuss today is probably behind that overweight, and also the insistence on keeping it.
But it's not the case that the UK is the only country where its investors have an overweight. In fact, I think we probably have the smallest overweight from the major markets. So if you look at Canada, Canadian stocks make up less of global markets than UK stocks, so around 3.4%. Yet Canadian investors have a little bit over 50% of their portfolios in Canadian stocks. And Australia is the one that really stands out. Their stocks are around 2% of global markets, and their investors have 2/3 of their portfolios in domestic stocks. So maybe the UK is not doing so badly here.
Yeah, and I've spoken to people in Australia, and one of the things they always complain about is the difficulty of buying ETFs, which have international exposure. It's not as easy. They don't have such a wide choice as we do in the UK, for example. But, they do have that choice now. But it is still the case that they have a huge domestic bias. And of course, their market is very odd indeed. Just as ours has lots of energy companies in the UK, theirs has lots of miners, it has lots of banks. So you're going to get exposure to that if you buy Australian domestic stocks.
I mean, that's one of the arguments against a domestic overweight, is that you're going to get a very strong sectoral bias, probably, unless you're in the US.
Yeah. For example, if you live in Taiwan, there's basically one stock you're going to have. And there was a really nice comparison in the Global Returns Yearbook, now from UBS, no longer from Credit Suisse, and they compare the concentration in the 12 largest equity markets. And in fact, the US has one of the lowest concentrations in the top 10 stocks, say.
It's weird, isn't it? Because we hear so much about the Magnificent Seven dominating markets, and yet most stock markets around the world are far more concentrated than the US.
Yeah, Korea, for example, 60% of the overall index, the country index, is concentrated in just 10 stocks. Taiwan, the one we just mentioned, similar. Same for Germany, same for France. Australia's 53% in the top 10. So, it's unusual to see a market which isn't as concentrated. And the US and Japan are two stock markets where that's true. They're not particularly concentrated in a handful of stocks.
So if you're in Australia, and we said they have 2/3 of their portfolio in domestic stocks on average, and that domestic stock market is dominated by just 10 companies, you're hanging your retirement on just a handful of firms.
which is risky because there's an idiosyncratic risk. And if some of those companies have a problem, and often they're concentrated in one sector, then it's going to be a huge problem for those investors.
I mean, this home country bias phenomenon has been known about for a long time. So I think it was originally documented in the early 90s in a paper by French and Paterba. And they looked at equity markets in the US, Japan, UK, France, and Germany. And they showed that, investors put a massive overweight on domestic stocks. And it has come down a little bit since then. But even now, like we've said, investors just seem to want to have a huge amount of their money in their home country. Why do you think that is? Do you think it's because of a kind of familiarity bias? Like we maybe know the companies that are near us and are more comfortable with them?
I think that's true. And people are also scared of investing in other countries because they may not trust the ability to keep on investing in other countries. Perhaps there'll be some kind of political problem about investing in foreign stocks. That's certainly happened in the past. We have had capital controls, even in the UK.
Oh, yeah. You're always lower down the pecking order as a foreign investor, I think. If things really hit the fan, so to speak, your risk of expropriation is higher.
And you listen to some of the discourse at the moment about the UK stock market and all the people complaining that people don't invest in the domestic market. And some of the solutions are like capital controls. The British ISA, at least, would tend to channel money in due to a carrot rather than a stick. But there is some discussion of stopping pension funds from investing abroad. And so that would just, by diktat, by law, force these companies to have a large UK investment, even if that's going to hurt return. And I think that's a really important point. If you're in a country which historically has not performed well, and also historically, politically, not favoured its own stock market, well, then I think it's kind of rational not to invest in your country's stocks and prefer an international bias.
I'd be interested to see if there are any countries like that. I'm not aware of any which have a negative home country bias. Even EM, the bias is strong. Like Chinese investors are pretty much all in Chinese stocks, not necessarily by choice. But I guess the broader point here is that is an argument in favour of having a domestic bias, is that you might be some kind of preferred investor by your home government. And you're not at risk of what happened in Russia, where your investments go to zero as a foreign investor.
Yeah, sometimes markets close completely, and it's because of a revolution usually or some kind of political instability. We saw this with the Russian market. We saw it for China when they had their revolution, and we also saw it in the Russian Revolution. Czechoslovakia, another country whose market essentially shut down. So I think you're right. It stops these kind of catastrophic outcomes. But will you get some kind of special treatment because you're a UK investor? I think the politicians in the UK really don't favour helping UK investors invest in UK stocks. That should change. But for example, we've got a transaction tax, a really large transaction tax by international standards. And yet there's no talk about lifting that, the stamp duty reserve tax.
That doesn't just apply to British investors, though. It's anyone buying British stocks.
Yeah, that's right. But there's no talk of scrapping it, which is kind of odd, I think. If you want to encourage people to buy UK stocks, surely you should reduce that transaction tax. So I think the problem in the UK is that we don't have a lot of incentives, I don't think, to buy UK stocks. Incentives, I think, are the way to go.
I mean, the other argument for holding domestic stocks in a larger allocation than foreign stocks is that you somewhat reduce your currency risk, because presumably your expenditure is in the same domestic currency as local companies are reporting in.
But again, I think here it matters which country you're in. And for the UK, what we've seen fairly steadily over a long period of time is weakening of sterling. And of course, that favours international investment rather than domestic. But it is true that if you invest in UK stocks, you don't have any currency risk at all, unless they're international companies, in which case they take a currency risk with their profits and their revenue. But really for stocks, I think the currency argument is a pretty weak one. I think for bonds, there's a stronger case to be made that currency matters more because the volatility of bond funds is generally lower. But the case in the UK, I think, is one that, firstly, we're a risky currency, and that usually means that if we invest internationally, then when risky assets are selling off, sterling weakens at the same time. and that reduces our losses. And then when risk appetite returns, sterling strengthens and markets rise. So overall, the effect of having a risk-off currency is that it reduces the volatility of our international investments, which I think is quite an attractive thing. But you're right. I think one of the arguments for domestic investing is you don't have to worry about currency.
And there's a related argument, which I find a little more compelling, which is some people say that domestic stocks offer better protection against domestic inflation. Because obviously domestic stocks will earn a higher proportion of their revenues in the domestic market than foreign companies. So for example, the FTSE 100 is very focused on international markets, but even there it earns something like 25% of its revenues in the UK, which is way higher than will be in American indices. And if you look at the FTSE 250, like the mid caps, they earn the majority of their revenue in the UK. So the idea is that if inflation gets very high in your country, wages are increasing, prices are increasing, your companies will be earning more revenue because they'll be earning it in those inflated prices.
Yeah, that certainly works up to a point. If inflation's not too high and it's not going to really crush margins for the companies in your country. So if we're talking about inflation of 5-6%, in theory at least, the companies could put up their prices by that much. And the people that buy their goods and services will be able to weather that increase. However, if it gets too high, it becomes a problem, and stocks usually derate at that point. So I think this provides some kind of domestic inflation hedge up to a point. But then I think the argument swings towards international investing, because let's imagine inflation's really high in your country, but not in the rest of the world. There's some kind of idiosyncratic problem in your country. Well, usually what happens is your domestic currency will then weaken. And of course, then it's better to invest internationally.
I guess you could point at Turkey, which has had weirdly high inflation, like exceptionally high inflation compared to the rest of the world. And yet its domestic stock market has done incredibly well. I think it was the top performing stock market, even in dollar terms, last year.
Yeah, and people invested in their domestic market because I think they couldn't invest in anything else that would match inflation. So really, it depends on everyone believing that's the case.
Yes. But that is kind of this argument in practice, maybe, that if you get weirdly high inflation locally, then maybe the local stock market is a better place to hang out than elsewhere.
Yeah, maybe. I think it really depends on how much faith people have in your own domestic equity market. I just think in the UK that wouldn't happen. If we had really, really high inflation, I can't see people pouring money into the UK stock market.
Yeah, I don't really buy it either. But someone's got to make the argument for a home country bias here. And the other point people make for why overweighting domestic stocks could be a good idea is that there's often lower costs for buying domestic stocks. And maybe there's a tax advantage for doing so. Depends what country you're in, obviously. Let's say the UK, we're often paying withholding tax on dividends received from foreign firms. Could be 30%, could be reduced to 15% in some countries. Whereas for UK dividends, we don't pay any withholding tax, obviously.
Yeah, that's one benefit. And of course, the UK is a big dividend payer. And so, that's one real good party trick for UK stocks. You're going to earn a high income if you buy them. I think the argument's a bit weaker because US markets are so large and they tend to pay quite small dividends. So the overall effect is not one of reducing your total return much because of the US dominance. If you are an international investor and you buy global indices.
And do you buy the argument around fees? So usually it would cost less as an expense ratio to buy domestic stocks. That's true for US investors generally, and it's true in the UK as well.
Yeah, I think as long as you stick to liquid markets, and here we're talking about usually developed market stocks, then the overall management fees tend to be quite low. And that's why I went for a global developed market index tracker, which had a fee of 0.12%. But contrary to that argument, there is a global equity tracker, which includes EM, and that also has a fee of 0.12%. This is the HSBC All World Tracker. So I think it's difficult to make the case that it's going to be hugely cheaper to buy domestic UK stocks because of the low fees for UK funds.
Yeah, I think this is one of the arguments that really was true like 15 years ago, but is no longer really a major factor.
Yeah, and the tax incentives also for the UK, there really isn't much of one yet. If there was a British ISA, very different. That really would turn the tables. But at the moment, I don't think there's a really strong case to be made in terms of fees, but also in terms of tax incentives.
Yeah, in the UK, it's hard to make the case that there's a big difference from tax and fees. It might explain some of the home country bias in other markets, though, where there genuinely are big incentives to hold domestic stocks. Another thing you maybe have to consider is that if you're in a market where seemingly everyone has a big domestic overweight, and you think, well, this is a bit silly, I'm going to hold just the world market cap weighted. Maybe in the event that your domestic market does outperform and everyone else is, like quids in and you missed out, you would feel a kind of psychological peer pressure there.
Yep, I think that's certainly true. If you feel as if you're going against the herd, you're always wondering if you've done the right thing. But I think in the UK, there's also the case that institutional investors have this huge UK bias. I don't know if it's because fund management products are easier to market if they've got a UK bias. Certainly when I talked to Vanguard about this, when I was just starting up PensionCraft, I asked them, I said, why do you have a UK overweight for life strategy?
A big one as well.
A huge one, like it's over a 6-fold overweight. And they told me that it was due to ease of marketing. They just found it easier to sell the product if it had more UK stocks in it. And if you speak to the average pension fund, if you've got your company pension fund, if you ask about how it's invested, I think a lot of you will probably discover that there is a big UK overweight.
Are we doing our patriotic duty, do you think, Romin, by buying our stock market?
Well, I've got a small overweight, so I'm slightly patriotic. But really, I think it's about believing in your own country. And there's lots to love about the UK. I think we're very creative, very good at innovation. We're not very good at marketing and developing the stuff that we've created, I don't think. Not as good as the US.
But when you look at the stats and you see that every country has a domestic overweight, every country is presumably patriotic, and maybe more so than us, they have bigger domestic overweights. And it's interesting when you ask investors around the world, is your local market going to outperform global markets generally? People generally say yes. They think their domestic market is going to do well. I don't say that, but a lot of people say that.
Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. As all good investors know, nobody can control what happens in the markets, but one thing they can control is their costs. That's why Saxo has lowered their prices so you can grow your wealth and more of your money stays right where it belongs, with you. Search Saxo, invest for less.
All right, so I think we've done as best we can at putting the sort of bull case for a home country bias here. Let's get back on familiar territory. What are the arguments against holding more than your fair share of domestic stocks?
Well, the one we touched on earlier was about having a weird sector composition. And most countries do have a sector composition that's unusual in global terms. Of course, the US dominates and it's very tech-focused. In the UK, we're very energy-focused in terms of the stuff that's listed on our stock exchanges. Also, lots of financials and lots of pharmaceutical companies. So I think this sector concentration is a problem. I think the concentration within the country as well is a problem, because eventually every country comes a cropper financially or economically, and having diversification kind of mitigates that problem.
Yeah, I would need a really strong argument to want to reduce my diversification in global equity markets. We generally think of concentration risk as a really bad thing for obvious reasons. Like, it doesn't take as much of a problem to put a massive dent in your portfolio.
And I think if you look at the UK's performance relative to global markets, let's say you look at the FTSE 350. So this is the mid caps, the FTSE 250, and the large caps, the FTSE 100, all of those taken together. And look at the performance year by year since 2009. How many years do you think the UK has outperformed the S&P 500?
There must have been some, I don't know, 2 or 3?
2.
At the lower end of my expectations.
So 2016, and the real stellar outperformance was 2022 during the tech wreck, when energy surged and the UK just looked amazing because it has no tech. And we didn't have any tech wreck at all because we didn't have any tech. So that was a great year.
Weren't we basically flat while the rest of the world sold off, though? It was great in the sense that we didn't crash.
No, I think we did rally a bit. So I think that's why we kind of looked great. But an 18% outperformance relative to the S&P 500 is not to be sneezed at. But then almost every other year, we've underperformed, particularly in 2020 when the S&P 500 outperformed by almost 30%. So I think the problem with the UK is just very poor returns through a very long period of time. And if we look at the last 30 years of returns, if we look at the real return, subtracting local inflation, the UK FTSE 100 has generated 3.1% total real return, and that's with dividends reinvested. Of course, that's our party trick. And the S&P 500 in the same period has earned over twice that, 7.3%. So I think that's why it's difficult for the UK investor to look at their market and think, oh yeah, I'm going to go overweight, when it's been such a train wreck compared to just the US.
I think people do it without thinking, though. They buy a life strategy fund, or they don't look at what's in their pension, or they just assume that the experts are getting it right. And yeah, they end up with a 25 to 50% allocation to UK stocks.
But I think this is also why Vanguard isn't shouting about its UK overweight for life strategy, because it's hurt returns. Ever since these funds were created in 2011, it's created a fairly consistent underperformance, except for those 2 years.
I don't think there'd be very many countries in the world which would look favourable against the US, right? Any domestic overweight outside of American investors would have looked bad over that period.
Yeah, since 2009, the global financial crisis, the US has been the real star performer on the international stage.
And hence, any way that you dialed down the US directly or indirectly would not have looked good from a return point of view. And that's always the risk, right? When you step away from global market cap. But it's interesting that American investors, particularly now, argue that, well, why do we need foreign stocks in our portfolios? Let's just hold the US. And you actually even see that in the UK. I see people saying, I'm only holding the S&P 500. And that, to me, is a recency bias and should set alarm bells ringing.
Yeah, because the US won't always be 70% of global markets, 60, 70%. It'll probably go back to 50% as it's been there for over a century.
But it's so easy to look at, 15 years of exceptional outperformance and think, well, that's just going to carry on. Maybe it will, but I wouldn't want to bet on it.
But that's why I always love these international comparisons and long-term comparisons, because it gives you a kind of context. So if we go back to 1900, again, looking at this Credit Suisse, now UBS, Global Returns Yearbook, you can see how the UK was 24% of global markets in 1900, and the US was just 15%. So these things do change, and I'm sure it'll change again in future for the US. Some other country will become dominant. Who knows what it'll be? It could be India, it could be China, or a country we've never even thought of. Not Belgium.
World X Belgium, that's the ETF you want.
Or Indonesia, a huge region. And if they started firing on all cylinders, just imagine what they could achieve.
But we're in a weird situation at the moment where the valuations in the US compared to other developed markets are so much higher that you've got British companies talking about moving their listing potentially to New York. Some have already done it. Even Shell, like the biggest listed UK company, has openly been talking about, well, we're getting penalised for being listed in London. Maybe we should just up sticks and go to America. That would be a huge deal if that happened.
Yes, that would be horrendous for the UK. Given its energy bias, if we lose energy stocks, then other companies will probably follow suit. And then, what is it that we offer? Why are we special?
The market has been shrinking in terms of the number of listed stocks, and liquidity is way down in the UK.
Yeah, it doesn't look good at the moment. I think it'll probably improve. I'm always optimistic about these things. I don't know why, but I am. And I think it probably will improve. I've no idea why, actually.
It's just mean reversion married with patriotism. I think one thing that I think a lot of people overlook when they hold a big overweight to domestic stocks is that maybe they've introduced wrong way risk into their life and their portfolio. So I could definitely imagine a scenario where domestic stocks do very, very badly because of a recession or a natural disaster, whatever it is in your country, which at the same time causes unemployment to spike and politics to become really unstable. And if you've got a domestic overweight, then maybe you lose your job at the same time as your portfolio crashes.
Yeah, we have this exposure to our country, and you don't have any choice about that. You have some domicile.
And also your labour returns over your life are tied to your domestic market.
Yeah, absolutely. And also your benefits in retirement, those might be affected by a huge economic crisis.
Really, to hedge your sort of income risk and political risk, you would massively underweight domestic stocks. You're already really long your home market.
And with your home as well. The
Yeah.
price of your home would also be tied to your local economy and also to the local currency.
So, given all that we've said here for why theoretically we can't see a reason for a home country bias, I was really surprised to see that there is some evidence that a moderate home country bias is beneficial to a portfolio. So I came across this from Ben Felix, who does a brilliant job on the Rational Reminder podcast on his YouTube channel. And he's based in Canada and manages investment portfolios and generally has a 30% allocation to Canadian stocks for his investors. So you might say, okay, he's incentivized here to say that overweighting Canadian stocks is a good thing. But he does point to some interesting evidence, one of which being a paper from Vanguard, which argues that a domestic overweight for Canadian investors reduces the volatility of the portfolio, just empirically.
So in terms of risk-adjusted return, it's going to improve your portfolio. That certainly matters in retirement because at that point, you really do care about volatility. And what you don't want is a crashy portfolio.
So that Vanguard paper argues that holding 30% Canadian stocks and 70% international stocks minimizes the long-term volatility of the portfolio. And the factors they took into account were things like the cost of holding the portfolio, the correlations between different global markets, the sector concentrations, and the currency effects. But I guess the time period you look at really matters with an analysis like this.
Yeah, and unfortunately, if you do the similar thing for the UK, the poor returns that we've had for a very long period of time would probably show that it's not going to help hugely having a big UK domestic bias. I haven't actually done the analysis, I've just looked at returns.
The interesting thing about that Canadian paper is that they look at returns from 1999 to 2023. So that obviously includes the dot-com bubble, which was a huge drawdown, particularly in American markets versus Canadian markets. So obviously, I think that's helped flatter the volatility of Canadian stocks.
Yeah, the dot-com bubble and the global financial crisis. I think the US was the epicenter and underperformed global markets due to that double crisis. Probably true for Canada as well, and for the UK, I think, to some extent. The other paper which was talking about this, which was kind of interesting, again, I came across this because of Ben Felix's podcast. Somebody posted it in our community. It's the Beyond the Status Quo, a critical assessment of life cycle investment advice, where they looked at domestic allocation and they actually showed that the domestic bias is actually helpful. For US investors, they said it was best to go 50-50, international and domestic. For non-US investors, they found that the domestic bias, the optimal one, was considerably smaller. It was 35%. I just wish they'd done it for the UK in particular, but still, I guess they're trying to make a general case here.
I mean, it's interesting. It's not a paper that looked at a back test and just analysed performance over the last 100 years. It's more about creating a model and seeing how a representative developed market domestic country would do with an overweight.
Yeah, so I suspect what they've done here is average overall non-US domestic markets, and they base it on 1 million bootstrap simulations. So this is taking historic returns and playing them as if those repeat in the future. And they simulate life expectancy, they simulate inflation, and also labour income. So you could lose your job for some period of time.
And like you say, they find the sweet spot to be around a 35% domestic allocation. And if you go below that, performance gets worse. And if you go above that, performance gets worse, which is roughly in line with what the Vanguard paper about Canada was saying.
But the curve is pretty shallow. If you make a small change up or down, then it doesn't make a huge change. So for me, having a 10% bias would be much more comfortable for the UK than the one you get from Life Strategy, which is roughly 25-30%.
I saw an interview with one of the authors of the paper, and he attributes this domestic bias almost entirely to currency effects. He thinks that is what really drives the little bit of benefit you get from an overweight.
So in the UK, I know in the 70s, when we had terrible economic problems here in the UK, sterling weakened a lot, and that was a huge worry for people in the UK. Unfortunately, at the same time, we had huge capital controls and we also had very high capital gains tax. So, I think it's difficult to see a world in which you couldn't have an economic crisis in your country and still be able to freely invest in other countries.
I mean, in terms of the strength of this evidence, I don't look at it and go, wow, I've been wrong. I need to weigh up my UK allocation here and get it to 30%, 35%. These papers where they're looking at one market over a limited period of time, or they're looking at modeling simulations of like a representative country, to me, that's not enough to move away from a global market cap weighted fund.
No, I think the shallowness of that curve showing how much better it is to have a domestic bias. I don't think it justifies a huge shift towards a domestic bias. Having some UK stocks, fine. I think that's absolutely reasonable.
Yeah, I'm not saying exclude the UK or your domestic market. I'm saying just hold it in the weight. Just be neutral, right, to whatever country you're in. Maybe just to wrap up then, one of the things that strikes me about home country bias is probably that most people don't know if they have a home country bias or not. Investors have just invested through their pension or they bought a fund in their ISA, and perhaps they don't know how that is allocated around the world.
Yeah, I think ignorance is one thing that leads people into bias. And if you just randomly choose stocks on your domestic stock market, you'll end up with a UK portfolio. So really, you've got to look at your own portfolio and just consider, is this what I want? Do I just want a UK portfolio with all of the risks that go with that? Or do I want something that's more diversified with the understanding that historically the UK has underperformed, but might outperform in future? Who knows?
I mean, some people might have listened to all this and be thinking, well, what's so special about market cap weighting? Why is that the neutral choice that 60% should be in America, 4% should be in the UK, blah, blah, blah? Who made this call?
Well, the beauty of market cap weighting is that let's say that there's no inflow or outflow from your fund and the index doesn't change. Well, if that's the case and it's market cap weighted, then the fund manager doesn't have to buy or sell anything to carry on tracking the index. The automatic growth and shrinkage of the individual stocks will match the market cap. So in terms of trading cost, it minimizes that trading cost. So certainly from a tracking perspective and from a fees perspective, it is the optimal way to invest. Okay, you're giving a huge weight to things which have been successful in the past, but things tend to be successful in future if they've been successful in the past, at least for some period of time.
And I think the theorist would say that efficient markets theory and the capital asset pricing model sort of dictates that market cap weighting is the most efficient way to construct a portfolio.
Yeah, those are the other theoretical arguments behind it, beyond the practicality of market cap weighting.
It's basically the idea that the market's incorporated all the information there is publicly available and priced that into stocks. So the reason the US has a much bigger weighting than the UK, because its companies are much bigger, because its profits in the future are forecast to be much bigger.
Exactly. And so I think there is a rational case to be made for market cap weighting.
But I imagine very few people are completely strictly stuck to global market cap. But even you don't have emerging markets in your portfolio, right? Everyone's got a tilt of some kind.
Yeah, it's hard to make a case that any index is completely neutral. There's always some kind of thing which makes your portfolio a little bit tilted one way or the other.
The only thing is to make sure that tilt is what you want it to be and reflects your beliefs.
Yeah, exactly. I think that's really what this is all about. Are you happy with the bias, and is that something you want to live with? Now, I mentioned the fact that I only found out about this Beyond the Status Quo paper because it was posted on our chat channel. That's one of the benefits of being part of our community. You'll find out all sorts of things which you'd never even thought about when it comes to investing. I've certainly learnt a lot. So if you want to join us, then to find out more, just go to our website, PensionCraft.com.
Okay, today's dumb question of the week is, what are safe haven currencies?
Well, this is interesting because it's often the case that people don't think of currencies as having particular attributes, but they do. Some currencies are commodity currencies and some currencies are risky currencies. And of course, the ones which aren't risky are safe haven currencies. And this is a shrinking club. The UK was once considered a safe haven currency a very long time ago. It currently isn't. And the ones which are would be the US dollar, almost certainly, the Japanese yen, again, almost as certainly, and the Swiss franc.
Interesting, because those three currencies are coming from very different countries. Like the US dollar, okay, I get it. That's the global reserve currency. If everything goes wrong, you probably back the US and the might of its financial system and military. But the Japanese yen, Japan has a huge amount of public debt, right? So why is Japan considered a safe haven? Its demographics aren't great either.
It is seen as a stable economy in the sense that, okay, they've got crazy debt to GDP, but when it comes to economic performance, they've been kind of okay. They've also got good rule of law. So from that point of view, they're seen as being politically stable. And Switzerland, of course, another case where it's seen as a politically stable country. It is a democracy. It certainly punches above its weight economically and in terms of the size of its stock market. And of course, it's got a history of being politically neutral during conflicts.
The other point I've seen made about these currencies is that they're all extremely liquid and reliably have fairly low inflation.
Yeah, Japan in particular was just kind of toying with deflation for a long period of time. They've finally got inflation. But it's also worth mentioning that the safe havens change over time. Switzerland was once just a very agrarian economy and didn't have this kind of global exposure or this reputation as being a stable economy and a safe place to park your money.
So what happened to sterling then? Why did we stop being a safe haven currency?
I think the 70s really rattled people. And I think as a global power, the UK clearly has been on a downward trend since the Second World War. The US very much took the mantle of being the strongest economy globally. And the UK just went into complete basket case mode in the 1970s. This is when we had to approach the IMF, we had very high inflation, and there was just terrible economic growth in the UK at that time. And ever since then, we really haven't recovered the mantle of being a safe haven.
And how does it affect investors then? Let's say we're a British investor. How is that different to being an investor who lives in one of these countries with a safe haven currency?
Well, it's actually something which hurts them, usually, because if it is the case that equity markets are selling off, then if you're in one of these safe haven currencies, let's imagine you're a Swiss investor and the US has sold off hugely. Well, at the same time, your currency, your domestic currency will be strengthening. So if you are a global investor at that point, it's going to hurt your returns doubly.
Would it strengthen versus the dollar, though, if the dollar is also a safe haven currency?
Well, it really depends on the nature of the crisis. But imagine that you're a Swiss investor investing in, I don't know, a global ex-US index.
Yeah.
Well, it's going to hurt you. So that's the problem. Whereas, like I said earlier, if you're a UK investor and equity markets sell off and your US investments effectively will be boosted by the fact sterling is weakening.
So is that maybe a case that if you live in a country with a safe haven currency, maybe there's an argument for currency hedging your foreign equities, whereas in the UK, maybe that's less of a concern?
Yeah, I think in the case of the US, they just forget other countries. They don't really care as much about other countries, and they just say, well, fine, I've just got the domestic market. I don't care about the rest of the world. If you're Swiss, you can't say that. If you're Japanese, you can't say that. So I think that's right. I think it is a case for currency hedging.
One of the many privileges that US investors have is they probably have to think about currency way less than everyone else does.
That's right.
Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.